Today's webinar is about co-owners. Do you have a buy and sell agreement? Of course, a lot of you will say, no, I don't have it. So what? Let me tell you, so what? So after this webinar, our goal is to perk your curiosity. So you will actually think of, okay, maybe I should consult with my attorney. I should consult with community CPA and getting something set up to make sure that the transition, the vision I have for my business is there, is being taken care of. All right, let's look at our website, folks. And this is our website, communitycpa.com. When you want to meet us and you don't have time to make that phone call, you can click that appointment button right here. And it come up with the list of the partners we have in our firm, and then you can schedule our time to have your question answered immediately. And you can actually click my name, so my availability will come up, so then you can choose the time that you want to talk to me. It is a paid service, which is ensure that what we provide you, and that you actually have a right to that content. And what we provide you would be the right thing to do for you. And we also have this YouTube channel, as you know, and you can subscribe to our channel. Then every time we have a new topic coming up, you actually will see it. In this channel, we have 3 languages right now going on, and pretty soon we'll be adding Vietnamese. But right now we have English, Chinese, and Spanish. So a lot of these topics between the 3 languages are repeated because we're trying to bring the same content to a different population. But you can pick whatever language you know on the title and to listen to our webinars. You can do the search right here, type in anything you want to know. We will have something come up because we have more than 1,100 videos in the system. We have been consistently doing videos for folks like you for the past 4 years. So accumulation, right? That's the power of time. We are writing on, this is our 4th year doing 3 to 4 videos each week on YouTube channel. Now, let's take a look at our webinar title, webinar content I prepared for you. Co-owners, if you own that business with somebody else, and do you have a buy and sell agreement? And in this deck of slides, and I talk about our firm, just kind of bring you closer to who we are, and not just knowing us as a community CPA, but knowing how we come from. And this is a 27 years old firm. And we started from 1 client, 1 account, to today over 12,000 clients worldwide. And we started with 1 location. Now today we have 5 locations. The newest one is Houston branch in Texas. And we started that branch, and now the branch is functioning. And we had our first new employee, and we had our office renovated. Everything is going. And with that said, I do want to brag about myself. And I served on this Federal Advisory Committee to IRS for 3 years. And I also have 2 books written. One is 8 a.m., the other one is 10 a.m. I am working on appointment with Ying at 2 p.m., which is expanding your business at this time. But these 2 books are starting your business, then growing your business. You need a different set of skills for yourself to go through each stage of the business development. Of course, sometimes you utilize people who are around you, and it is hard for someone to have the set of skill at the beginning 8 a.m. and also have the skill for 10 a.m., for 2 p.m. That is a very hard ask, but you could, team up with people, know what you needed, then team up with people to do what you want to do for your business. No responsibility disclaimer. That is a regular slide we have in our deck just because we need you to take responsibility of what you hear and what you do. If you really want to secure your actions with backup, knowing that this has to be right because I had the consultants, I had the lawyers, I had the CPAs look at this, and you want to make sure that it's a fee-based service, right? For you to pay a fee is not just because you need to have that damage to your wallet. It is actually a way to trade for that knowledge to yours. So a lot of those professional service firms, just like Community CPA, are actually insured with their error and omission insurance. So in case damages caused, and that insurance will come in to help you. So you want that kind of responsibility, and you do want to pay for professional service to get yourself there, that knowing you are safe. All right, so let's talk about co-owners. As soon as we say co-owners, what does that mean? That just means that in your business, you have more than one owners. A lot of times, co-owners can be just two, but it also can be multiple people, like owning the business together. So let's kind of look at what kind of tax structure the co-owners would have in our tax system. Right? You call yourself, oh, I'm the co-owners. What exactly mean on the tax side? People don't see. Your customer know you're one of the bosses, right? But on the tax world, at the legal side of the spectrum, what kind of tax structure you are in? So let's kind of pull them out to give you a quick summary of the tax structures for co-owners. There's several. And the most popular, of course, is the partnership. Co-owners are considered partners. So like CPA firm, you can have multiple partners. And law firm, you can have multiple partners. And restaurant, you can have multiple partners. So the ownership are the partners. So that's co-owners. Limited liability company, that co-owner can be chosen to be taxed as a partnership, corporation, or S corporation. Depends on what kind of tax format, your tax structure you're choosing, you're electing. Your LLC could show up differently. The co-owner could be accounted under the membership unit or under the shares, right? So that's all ownership, but in different structure, in different tax structure, it's called differently. So in the membership structure, this is more like a partnership LLC, so you own the membership. And then, of course, come to corporation, you own the shares. So that's your shares. When we talk about unit price, per share price, we're talking about unit is membership unit, shares are corporation shares. So structure of the co-owners means that you may be owning a percentage of membership or percentage of shares, right? So that is where we're driving this conversation. We want you to know that if you have a membership unit, you're actually owner as well. Corporation also can be a co-owner. So you are a shareholder, you own shares, right? And a corporation can be C Corp, S Corp, so you are shareholders. So proprietorship for married couple, one spouse can be considered to be the sole proprietor for tax purposes in your filing Schedule C. So you're a married couple, you have this business together, but one of you can file a Schedule C in your 1040. And the qualified joint ventures is the same. It is qualified joint venture means married co-owners can elect to be treated as a sole proprietors, and each of you to report Schedule C, self-employment income, those forms, to report your income and expense. See, these are structure of co-owners. So you don't want to say that, well, I filed Schedule C, so I don't co-own anything with anybody. It's just me, it's my part. No, you are co-owning that business. You just kind of cut it up into proportion, and you reported Schedule C here, the other person, your spouse, and your co-owner was reporting the other one. Tenancy in common. Co-owners report their proportional shares of income and expenses on their own 1040. So this tenancy in common is not married couple, right? You are just together, so you separating, you're just reporting your Schedule C separately. So when we talk about co-owners, it is not about whether you're getting a K1 and whether you're getting you're filing Schedule C. As long as you are working in unison for one business, you are co-owners, right? So we want to clear that definition first. Then let's look at what is buy and sell agreement, because our title today is co-owners and do you have a buy and sell agreement, right? So what is that? Why do you tie buy and sell agreement with co-owners? And let's look at what is buy and sell. A buy and sell agreement is a legal binding contract, normally done by the attorney, that outlines the procedures for redistributing the business ownership, whether it's unit or it's a shares, and ownership in the event one of them can no longer hold the ownership. So those are scenarios, right? What can be, in what case one of them just cannot be in the ownership? Anything can. Maybe the person just have a very bad, temper. The other person can't deal with that person anymore, and then they don't want to be in the business, simply want to leave the business, right? And incapacitation is another reason. Maybe the person somehow had an accident, car accident, could not function anymore, then they just cannot run the business anymore. What about your co-owner die, right? Those are scenarios, we call them triggering event. The event that would trigger the ownership to be dropped by one or multiple owners, to be giving up, or to let go of that ownership. It acts as an exit strategy. This buy and sell agreement, it is a tool. It is a tool to say something ahead of time, to provide a strategy for the business partner to somehow has the right, already has the tool to know what to do in case something happens. It's literally a prenuptial agreement for a business. You know how when two person getting married, if the wealth is very different, one person is a billionaire, the other person maybe not. So at the wealth level, it is possible that for the newly married couple to have this prenuptial agreement to say that whatever happened before the marriage is not going to be divided after we get divorced, right? So that is prenuptial agreement. So this buy and sell agreement just sounded so benign. It's like it didn't sound anything fancy, but it is a strategy agreement for you to exit, for you to peacefully leave the business, knowing that everything will be taken care of. So it is a thinking ahead of time kind of agreement. It is detailing how asset and ownership will be divided upon the dissolution of the business or the departure of one person, right? So that is the buy and sell agreement. We're talking about a strategy agreement for business owners to peacefully, understandably leaving the business, and leaving the business with a good with a good platform, they can continue. The continuity of the business is intact because of the departure of the owner. All right, so what are the key? So you may say that, oh, Ying, okay, fine, I understand. It is important, but if I have to remember what need to be in the agreement when I talk to my attorney, what are the things I should say? Here you go. I do have a couple of things I want our folks to remember. And I know you can find a good attorney to do this, but you yourself need to know what you must address. Number one, ownership transfer. It specifies how ownership is transferred. ensuring a smooth transition and preventing potential disputes among remaining owners or your heirs, right? And evaluation number 2, anything you transfer, it comes with a monetary value. If you don't even know how much your business is worth, you can imagine the dispute gonna start right here. So what is the valuation? You must agree ahead of time. The agreement should set a fair price for the departing owner's share, detailing the term of the payment, right? So valuation of your business is really key. So you can say that, oh yeah, we're just gonna say a third party would come in to evaluate the business and that's it. That may not be specific enough. A lot of time, I have seen cases, the evaluation was done by one company, but one of the 3 owners don't agree with that valuation, thinking the report is a template. Who did that valuation? And it's charging us $8,000. Are you kidding? It is a template. I even find another company's name on there. This is not our valuation. So the valuation was denied because of this third-party document wasn't really that great. Then what are you going to do? So the business has to do another valuation, right? So that valuation need to be defined by whom, and when that is done, and there should be no argument. A lot of times what I see about valuation, the companies that evaluate the business, they tend to use the number from the tax return. Did you hear me? They use the number from the tax return to determine the value of the business. Just keep that in mind. You can make your valuation so simple. You just use, for example, the sales amount. So sales amount, maybe 50% of the sales amount is your value. Maybe 100% of the sales amount is your value. You decide, right? So valuation is so important. Not about, oh, we're going to value the business and divide it by number of shares. There you go. The value is here. No, you want to define what is the value for your business in that agreement. Triggering event. So you also need to name it. What is triggering event? It defines the event that could trigger the buy and sell process, such as death, disability, right? Retirement, voluntary departure. Just don't want to do it anymore. I'm done. And that partner make me sick. I just want to be done. That's okay too. Those are triggering events. You want to put that in the agreement. Funding. You want to figure out how the other party would pay for it. So let's say I want to depart and I have this business with the other person. The business is worth $100. So use simple dollars to do this illustration. So I'm leaving, I'm 50%. So the other party, the other owner should pay me $50, right? So if I got $50, I walk and he has the whole company. But what if he doesn't have the $50? And one of the very often method, like I wrote there, life insurance policy are purchased on the life of each partner to fund the buyout in case of the death, or or other means used to fund that money. So life insurance is one to fund one of the triggering event if someone dies. So let's say I buy life insurance on my partner. So if my partner die because I have to buy that share, his life insurance beneficiary is me. So I will get the payment, right? I'll get the payment, I can pay. So I can buy that share. So with that said, you understand how to do that life insurance, right? It is not you insure yourself and give the benefit to your kid. No, you're going to insure yourself, give the money to the company, or you're going to insure yourself and give the money to the other party so they can use that to buy your shares. So you get that money back, right, for paying the shares that you're selling. So those are the 4 very key items in this strategic exiting agreement. We call it buy and sell agreement. Very benign term, but it is to arrange your future. So you want the ownership transition to be defined. You want valuation to be defined, triggering event to be listed, and the fundings. How do the other party pay for your exit? That's important. All right. So this agreement basics. Let's talk about these kind of strategic exiting agreement. There's major two type. One is cross-purchase agreement. There's are two basic, right? This is one of the most common type of agreement. It's called cross-purchase agreement. A cross-purchase agreement is a contract between you and the other co-owners. Under the agreement, a withdrawing co-owner's ownership interest must be purchased by the remaining co-owner if the triggering event such as death, disability occurs. So you must purchase the person who died, right? Cross-purchase agreement are beneficial because they provide a clear agreed-upon method for handling the departure of the other owner, which can help prevent dispute, ensure the business continuity. That is so important. You want the business to move on like nothing happened, right? However, they can become complex when you have more than one partners. So that is a cross-purchase agreement. If one is gone, the other one buy it. So you need to figure out how to divide that. The other one, there's two major ones. The other one is called the redemption agreements. Basically, the difference between the redemption agreement and the cross-purchase, the redemption agreement, it is the one that the remaining owners buy out the departing owner's shares. This is where the cross-purchase agreement is the remaining owners buy out the departure's share, right? But under this redemption agreement, a withdrawal of a co-owner's ownership interest must be purchased by the joint-owned entity if a triggering event happens, which means, let's say, if I have a partnership with you and you are disabled, you're leaving, so I don't buy your shares. What happened is the company we two own together buy your shares. So it belongs to the company. And the advantage of redemption agreement includes creating a market for the shares, because once it bought into the company, then it is available. And it's the market. It's not just you have to buy it, it's other people can buy it. And it's providing liquidity for the estate of the deceased or living owner, right? Ensure the business continuity again. So the redemption agreement, it is mostly used by companies that has a lot of cash flow, and the company itself has money, so they can just purchase the other owner's share in. So let's say we got 100 shares. I have 50, you have 50, you are gone, then the company buy it in. So now the company do have 100 outstanding shares, but the other 50 is made available for other shareholders to buy. So it's created a market for the company. Now, knowing the two type of the agreement in this particular strategy session, right? We call that a strategy exiting agreement. So that's the two most common. Then, of course, triggering event. You and the other co-owner specify the triggering events you want to include in your agreement. You certainly want to include obvious events like death, disability, and retirement, right? You obviously do that. But you can also give your own. And give your own maybe something more like I would say buy and sell agreement can also include, well, one of the partner reached 62, and then has to be sold. So you can make that determination. And of course, you can also include other events that you deem appropriate, such as if you divorced, if the partner divorced, the wife, going to take over or not, right? So those are the triggering events you really have to think of. When you work with very experienced CPAs and attorneys, they will have experienced thinking for you. And a lot of times, if you don't define the triggering event in all conclusive, then you may run into a situation where that agreement you had in the closet just doesn't work because it didn't have any reference to what's going on right now. So you want to think in completion related to triggering event. Otherwise, you don't use that agreement, right? The triggering event is very important to come in. And of course, valuation and the payment terms is one of the 4 key things we mentioned earlier. And make sure your agreement stipulates a acceptable method for value your business ownership interest. So a lot of times in the professional firm, you see that very often, and particularly in the CPA firms. I look at those data, so I kind of understand how exactly it works. In terms of the value for a law firm and CPA firm, a lot of times is the gross sales, whether it's 1 times, 2 times, or 50% or 0.75. So whatever ratio they're using, but they are fixated on the total sales. So of course, manufacturing will be different. A lot of time, manufacturing is more of looking at gross profit. So in restaurant, a lot of times they're looking at the asset as part of the value. So it's all different between your income statement and your balance sheet, and you can figure out a very sustainable, easy calculated value. You don't have to go for extensive studies and research figuring out what your value is. When you sell your business, valuation is very subjective. It is something that as long as you can reference to a certain amount on your tax return and you understand where that dollars come from, that would give you the strongest support for your demand. And if you're looking at buying something and you want to see their tax return in I have never seen anybody who buy or sell anything without looking at the tax return. Why? Because tax return is a documentation that you can rely on. It's filed with the IRS already, so you can see the history, how the business is. And anything outside of the tax return, you can regard that irrelevant. Someone tell you that, my sales is actually 3 times more than what I report. Don't look at my tax return, it's not right. That kind of business is probably not suitable to buy anyway, because you don't even know what they're hiding in the closet, right? So valuation and the payment terms, you must make sure your buy and sell agreement stipulates the method of valuation. And a common valuation method including using a fixed pre-share price, a appraisal fair market value figures, or formula that sets the selling price as a multiples of earning or cash flow, use sales total, all kind of ideas depend on your industry. So there are common valuation method you can use. Also, to ensure the agreement, to make sure that the agreement specifies how the amount will be paid out to the withdrawing co-owner or their heirs under different triggering event. So you want to figure out, okay, fine, the valuation is $50, but how are you going to pay it out? Is it going to pay out right away, or is it going to pay out by multiple years? So what is your cash flow? How you can figure this payment out. So that is really important, practical. A lot of time it is actually in the life insurance policies when they have those kind of agreement. So I have one page to talk about life insurance policies. So the death of the co-owner is perhaps the most common and most common triggering event you see in business world. It just happened, right? So you can use life insurance policy to form the financial backbones for your agreement. So specify in your agreement that any buyout that isn't funded with insurance death benefit proceeds will be paid out under a multi-year installment agreement. Of course, that insurance will be paid out in one lump sum, but maybe not enough, so the balance will come in for installment. And this will give you some room to come up with the cash flow that you needed when you are doing when you're going through the sale. And the other slides I have here is related to cross purchase, because cross purchase really require the other co-owner to have money. So in this case, the life insurance function is very important. That should probably be tied to this type of method. So if one co-owner dies, the surviving co-owner collects the insurance death benefit proceed and use that to buy out the deceased co-owner interest from the business, from the estate, and surviving spouse and the heirs. So that, we talk about in multiple points we already mentioned to you. So each partner have a life insurance, but that insurance beneficiary is actually the other partner. Just so you are clear on how the direction goes when you work on the life insurance. Of course, you can talk to the insurance agency. If you just mention to them that you're doing the buy and sell agreement in the event of triggering event like co-owner die, things like that, and you're doing a cross purchase agreement, then this is what their daily soup. They know what to do. All right. So what if you have more than one owner, more than two, and it's not as simple as you and that person, it is a lot more. In that case, the company should put a trust in place. The simplest way to have the trust to receive the payment, then divided that out. That's what the function is. In this scenario, you may want to use the trust to buy and maintain one policy on each co-owner. So you're going to buy those policies with all of them, but it's maintained under a big umbrella of trust. Then use that. Then if co-owner A person die, the trust will collect the death benefit proceed tax-free and distribute the cash to the remaining co-owners. Then they can use that money to buy that share that is outstanding, needing to be purchased. So with that, and I want to say that using life insurance to fund this type of agreement is often seen on the market. And with life insurance to fund redemption agreement, to fund the redemption buy and sell agreement, the business entity itself buys the policy, not you, not the co-owner. Okay. In the event of dies upon death of the owner, the life insurance proceeds are used to buy back that shares. So the different, on the redemption side, you just know that it is the company, it is the joint business entity will do actions of this kind, not the other co-owner. And to create certainty for heirs is the function that the life insurance would offer. Because once you have these kind of things put in place, the person who deceased obviously it's their heirs will be working with you. They are the one that needing the money because the the person worked their whole life for this business, right? So this is where you can really taking care of the family, but at the same time not making any changes to your business. Let the business go as it is. The value of your share of the business of your share of the business, it is part of the estate for the deceased person. So without settling this, they can't even finish their estate side of the business. So it's important, and you have these arranged already. When that happens, is wrapped up quickly. Most of the estate cases, we see in our clientele is wrapped up within between 6 months and 2 years. So unless you don't have a lot of things going on, you can wrap up your estate. Your co-owner can wrap up the estate really quickly. Otherwise, with business, you're looking at 6 months to a year. And if you do it this way, imagine that if you really drag this out without this agreement, you don't know what to do, then your business will suffer because of the instability. But if you already know what to do and you got this estate already taken care of, you have the money, buy the share, pay the heirs, and then your business can go on just as it is. So it is very important when you in the rocky space where your business is still leveled up. That's where we say that you need to have that agreement, really think about it. Okay, concluding thoughts. It is important for business to have this buy and sell agreement to avoid legal and financial complications. You want to maintain the control of the company as a survivor, right? And you want to protect the interest of all parties. The other person have heirs, and you want to protect their interest as well. It is typically recommended to set up a buy and sell agreement during the early stage of forming a business. So two of you got together to do a business, you should have that agreement. Okay, and it can be established, of course it can be established later, at any point of the life cycle. In my 8 a.m., you really should establish, but 10 a.m., 2 p.m., it's okay. But the later you establish, and there's just more demand on that valuation, and you would have more understanding of your business, so your valuation could be more accurate. So with that saying, there's no good, bad, and the worst. It's just that when you are in business as a co-owner, having this kind of agreement in place is only going to give the benefit to people who come after you. And I think it is the owner's responsibility to perform like that, and to know that your responsibility not just to run business, and it's also to last the business. Right? And coming back to the same screen, if you have any questions for Community CPA for me, and you can find me on this page on our website, and you can book my time and I'll come to you via video conference. And then this is our last slide. And you can go on to the YouTube channel, Community CPA channel. You can subscribe. And when you see the videos you like, give us thumbs up. That tells us someone benefited from listening to our videos, and we enjoy seeing that. Of course, our website, communitycpa.com. You have an email of Catherine's, Catherine at communitycpa.com. And she is our marketing manager. She knows what folks need. If you have certain thought, you want that to become a webinar for you, and you send it to her, and she will work with me, and we will come up with what we need to talk about, and be online for you, and you can listen to the answers to your question online at any time. All of our webinars is deposited back into YouTube channel 24 hours later, so you will see our whatever I talked about today for you. And you can call us at this number, 515-288-3188. Know that we open 6 days a week. So don't be shy on Saturday, and you can pick up the call, and it will answer your call and take care of you. Okay? We will see each other again On Tuesday,